I don't care what the big companies try and the marketing guys at these companies try and sell you on the idea that, oh, but if you do this for that many years, we'll give you this back and you'll get some of your premiums or all of your premiums back. That is all marketing bullshit. That is what it is. Because all they're doing is they are charging you more for the insurance that you're taking out, and that extra money gets kept by them. And if you then jump through all their hoops, through all their rules and regulations, they will then give your own money back to you.
Financially raw, real, authentic wisdom with Lourens Oberholzer from Retire Rich and Happy.
So, firstly, our topic for today. Today I thought I'm going to talk to you about why it is important to review your life insurance. And we're going to talk a little bit around life insurance, what you need to know, what you need to look at. If there's any questions, you are welcome to give us a shout out on the website. Please chat to me. I'm alone in studio today. So, talk to me, keep me company, ask me questions. I'll be happy to answer those questions for you. Also, if you want to follow us, you can follow us on YouTube. You can just search for I Retire. Facebook's Retire Rich and Happy, and then our website retirehappy.co.za. On the website, you will also see a link to register for our coaching webinar, which you can attend every Tuesday evening at 7. Just follow us, give us a shout out, and I look forward to the hour that we're going to spend with you. So like I said, today we're going to talk about why you need to review your life insurance. So the first thing I want to chat about is, what do I mean by life insurance? Because too many people think life insurance is, oh, when I die, there needs to be money for my family. But I don't have children, so I don't need life insurance. So the first thing you guys need to understand is that life insurance is not life cover. It's not the same thing. Life cover is a type of life insurance that will pay to beneficiaries in the event of your death. But life insurance as a total definition is any insurance you take out on what happens to you in your life. So that includes things like you getting cancer or you getting into a car accident and becoming disabled. That is all part of life insurance. So just keep that in mind. Life insurance is not life cover. Life cover is just a portion of life insurance. So I believe that every adult earning an income needs some kind of life insurance. You might not necessarily need life cover, but you need some kind of life insurance, because the moment you become an adult, the moment you start looking after yourself financially, you need to start minimizing your risk so that if anything happens, that your life or your dependents' lives, if you have dependents by that time, can continue in the same manner as it was used to. So I get to so many clients, and when we talk about taking out life insurance and we talk about spending 1,000 Rand or spending 500 Rand or 2,000 Rand or whatever the case may be on their life insurance, they sort of back off, and it's like, no, geez, that's so much money to spend on life insurance. But that same person is spending 3,000-4,000 Rand a month on their short-term insurance, their car and household insurance. And the story I usually tell is the story about the goose that lays the golden eggs. If you had a goose and every morning the goose laid another golden egg, and you can go sell that egg and use that the money from that egg to support your lifestyle, to pay for your house, etc., etc. What would you insure? Would you insure the goose, or would you insure the eggs that the goose lay? And the obvious answer is, of course I'll insure the goose. Why would I insure the egg? Because if the egg breaks or gets stolen, I can always get another egg from the goose. But if the goose is gone, then there's no more eggs. And then we look at what we look at in our own personal capacity. You are the goose that lays the golden eggs. You go to work, you do something to generate income for the family, to make sure that the family is looked after and can maintain their standard of living. But then we spend thousands and thousands and thousands to insure the eggs, but we don't insure the goose. So don't fall in that trap where you spend more money insuring the eggs than you do insuring the goose. But saying all of that, there's a very important thing that you need to keep in mind, and that is how you need to approach your life insurance. Unfortunately, for generations, the approach to life insurance from advisors, from brokers, from financial advisors, or whatever these guys call themselves, the approach has been to try and beat what you've got. And that is exactly the wrong approach, because then you do not know what you are actually paying for. I usually say most of the time people pay for these things on hope. And the purpose is to move you from hope to surety. You need to know what you are covered for and what you are not covered for. So you need to understand it. So the approach typically is to beat what you've got. So what typically happens is a person comes and sees you and they look at the first thing they say is, let's have a look at what you've got. And they'll say, well, we see that you have 3 million life cover with company A. We can give you 3.2 million life cover with company B, and then we're going to give you this bell and this whistle and this little bonus back if you jump through this hoop or whatever they try and sell you on. And then you go, well, it's 3.2 million life cover instead of 3 million life cover. That sounds like a good deal, and you move. But the question isn't whether 3.2 million was better than 3. It was, did you need 3 million rand in the first place? Why do you have 3 million rands worth of life cover? Is it enough? Is it too much? Is it too little? What does it actually mean? So the approach to your life insurance must always be not what have you got, but what do you need first? That's the first question you need to ask. Before you even look at life insurance, you need to first ask yourself the question, what is it that I need? And only once you've determined what you need, you then build something that does exactly that. No more, no less. Because everything that you spend into life insurance is called what-if money. It's money that you pay a third party, some insurance company, for in case something happens to you. This money doesn't build up an asset value. It doesn't build up a cash value. It doesn't come back to you unless one of these eventualities happen. I don't care what the big companies try and the marketing guys at these companies try and sell you on the idea that, oh, but if you do this for that many years, we'll give you this back and you'll get some of your premiums or all of your premiums back. That is all marketing bullshit. That is what it is. Because all they're doing is they are charging you more for the insurance that you're taking out, and that extra money gets kept by them. And if you then jump through all their hoops, through all their rules and regulations, they will then give your own money back to you. It's not like the insurance part of the policy actually comes back to you. The insurance part that you pay for is gone the moment you pay for it. So let me quickly explain how insurance works in simplistic terms. Insurance is basically a gambling arrangement between you and the insurance company. How it works is like this. You go to the insurance company and you say to them, listen, I think I'm going to die this month. That's what I think. The insurance company, okay, I'm listening. And then you go and you say, so I'm willing to bet 500 Rand that I'm going to die this month. But if I'm right, you're going to pay my family 3 million Rand for the 500 Rand that I've bet. The insurance company then looks at your health situation, they look at the risks involved in your job, everything related to you, and they say, well, okay, we'll take that bet. If you die this month, we will pay your family 3 million Rand, but if you don't, we keep the 500 Rand. You then put your 500 Rand on the table, they put their 3 million Rand on the table, and then we go through the month. At the end of the month, you haven't died, and then the insurance company goes, great, we won this bet, and they take your 500 Rand. And then they say, well, would you like to take this bet again? And then you go, yes, I think this month I'm going to die. And then you repeat that process. And that is, in simplistic terms, how insurance works. This thing that the insurance company will say, we'll take the bet, and then you lose the bet, and then they just give your money back to you, is utter and complete nonsense. You need to understand that. It's utter and complete nonsense. It is extra. So what the insurance company does is they say, well, we'll take the bet for 500, but if you pay us 700 Rand, we will keep the extra 200 Rand on your behalf and pay that back to you if you follow the rules that we have set out. Now, I don't know about you guys, but I would rather keep that 200 Rand in my account, invested in my investments the way I want to, instead of giving it to an insurance company and waiting for them to give it back to me. That's just me. If that is what you want to do with your money, by all means. But for me, I want to have control over my own money. So there's a few different areas that we need to insure. So there's primary risk areas and there is secondary risk areas. The primary risk areas are the most important parts that needs to be insured. So what I see so often is I sit with a client over the 22 years that I've been in the industry. I sit with a client and then the client he's spending 500, 600, 700 Rand a month on a whole bunch of secondary risk areas. But his primary risk areas isn't sorted out yet. And then what that means is that if one of these primary risk areas, if one of those events happen, then the secondary risk area won't mean anything in any case. And I'll give you a little bit more of an explanation of that as I go through the different risk areas. So the primary risk areas, first and foremost, is life cover. You need to have life cover if you have dependents that are dependent on you. So you have children, you have a wife. Even if your mom or your dad has become dependent on you, you need to have life cover. Because if you pass away, your ability to generate income for the family is lost, and we need to replace that income. We will talk a little bit more about how do you determine how much life cover you need as we go through, but life cover is crucial. The second primary risk area is your capital disability cover. So that is a lump sum amount that needs to pay to you in the event that you become disabled. You get paralyzed, you get in a car accident, any of these things that can happen. So the purpose for that cover is to make sure that you have enough money in the event that you become disabled to pay off all your debts, and secondly, have money for changes to your lifestyle. Things that you need to change in your lifestyle in the event of that happening or as a result of the disability. Things like, for example, you need a new bed, a bath, a wheelchair, you need ramps built at home, you need to adapt your car. All of those kind of things you will need to have capital for to buy. And if you don't have provision for that, then suddenly you're probably going to have to go into debt to buy these things. And then it's sort of a pointless exercise to have enough cover to pay off the debt if you're just going to go back into debt. The third one is your income disability cover. Now, some people, because of their occupations, because of their qualifications, might not qualify for income disability. If you cannot qualify for income disability, you then move back to capital disability and make sure that you have enough capital cover on disability so that that capital can be invested to generate enough income for you after the debts have been paid and you've done your change to lifestyle. But income disability is an income replacement benefit that replaces the income you were earning from your job or your career in the event of a disability. And that income is what you need to maintain your standard of living. So you are ensuring your ability to earn an income. And then the fourth and the final primary risk area is your severe illness cover. Severe illness cover is things like cover for cancer, strokes, heart attacks, diabetes, all of those kind of severe illnesses that you might be diagnosed with. And a lot of people look at severe illness and say, but isn't that why I have disability, or isn't that why I have a medical aid? Severe illness, and I'll talk a little bit more about it as we go through, but severe illness works like a seal between the main things that can happen to you. So it is over and above what your medical aid will pay, and it's before your disability will actually pay out for that illness or what happened to you. So those are your 4 primary risk areas in your life insurance. Yes, I understand other things that are important are things like your medical aid, things like your will and your estate planning to make sure that there's enough funds and provisions for winding up your estate. But the 4 primary areas on your life insurance policy is your life cover, your capital disability, your income disability, and your severe illness. Another thing that's very important is to understand the difference between standalone benefits and accelerated benefits, because this is what happens to a lot of people. They have a specific policy, and again, like I said earlier, when people the typical way people approach insurance in the industry is they try and beat what you've got, and typically on premium. So what often happens is the person that tries to sell you the policy comes, you might have standalone benefits on your existing cover, they convert it into accelerated benefits, and then it works out cheaper, and then they say, but see, we've got the same cover, but it's now cheaper than what it was. And then you move because you think you're in a better situation, but you are not in a better situation because it's not the same cover. So I'm going to quickly explain the difference between standalone and accelerated benefits. So standalone benefits is each one of these 4 areas are completely separate from one another. You have life cover for that event. You have disability for that event. You have income protection for that event, and you have severe illness for that specific event. The one area doesn't influence the cover on any other area. So let's say, for example, you become disabled and your disability pays out 2 million rand. That has no effect on the amount of life cover you had. So the one doesn't influence the other one. Accelerated benefits are all combined into one benefit. So you might have 3 million life cover, 2 million capital disability, and 1 million severe illness. If your disability pays out, it reduces your life cover with the amount that your disability has paid out. So if that 2 million pays out, your 3 million life cover will suddenly reduce to only 1 million. So it can only ever pay out a maximum of 3 million rand. If you then get a severe illness and that pays out 1 million rand, then suddenly you have no life cover. Now you have been declared disabled. You have had a severe illness. For you to now qualify for life cover is going to be either very close to impossible, or if you get it, it's going to be extremely expensive. So you always want to look at your insurance and make sure that more often than not, I would say 95% of the time, you want it to be standalone benefits. So where do we use accelerated benefits and why is it there? So accelerated benefits is usually when the risk cover is taken out for a specific purpose. So let's say, for example, you have bought a house and you've taken out a bond for 1.5 million rand. You need to have a little bit of an insurance to cover that in the event of your death or your disability. So in that case, you can do it as an accelerator benefit because the purpose of that is to pay off the bond in the event of death and disability. So if you become disabled, the 1.5 pays out, it pays off the bond. Now you do not need the life cover anymore because the purpose have been served. Therefore, in that scenario, you can get the cover for lower premium because it only has to serve that one purpose. But more often than not, it has to be standalone because the fact that you've become disabled doesn't necessarily mean that you don't need any more life cover. Okay, so that's very important to look at. Then secondary risk areas. These are the add-ons that you get sold often. Things that they add on to increase the premium that you are paying. Those are, and this is not all of them, this is just some of them. The first one is premium waivers. So they put on a premium waiver on disability or a premium waiver on severe illness. What a premium waiver means is that in the event that you become disabled, the company will start paying the premium on that policy. You don't have to pay it anymore. The problem with that, though, is if you plan correctly, the income that you have planned for will be enough to pay for those premiums in any case. And more often than not, those premium waivers won't increase your cover over time. It will just stop your cover at that level, and you will always have that same amount of cover. So that, for me, is something that you rather build into your primary risk areas instead of adding it as a secondary risk area. Secondly, you have things like educator benefits, where in the event that you pass away, become disabled, the insurance company will pay for your child's schooling. Now, in effect, there's nothing wrong with that benefit. It is a good benefit to have, but only if you are sure that your primary risk areas have been covered. So what I see is people sit with this educator benefit on their risk cover, but they don't have enough life cover. They don't have enough disability cover. So here's the scenario that happens. If one of those events happen, it's all good and well, your child's education is sorted out, but suddenly the family can't afford the house. The house gets sold. They don't have enough money to look after themselves. So the first thing you need to do is you need to make sure that your family can sustain their standard of living as it is at the moment. The next one is child illness cover. So you have extra cover where you can take out severe illness cover on your child's life. So in the event that your child gets a cancer, leukemia, any of those kind of things, they are covered for that. But again, that's a secondary risk area. It's no use you putting cover on your child, which has a very low probability of these things happening, but you are not sorted out. Remember, who is the goose in the house? You are the goose that laid the golden eggs, not the child. The child doesn't lay the golden eggs, you do. You first sort yourself out, and then you start looking at secondary risk areas if you feel that that is something that you need or would like to cover. Then we have things like trauma cover or accidental cover, which says that if you have some traumatic event, you are in ICU because of an accident or something like that, there will be cover paid out for you. Again, that is a secondary risk cover. Then female cancer benefits. I know there's companies that phone all over the place, over the phone, send you free gifts. I think all of you know who I'm talking about. And they sell accidental cover and female cancer cover. Now, female cancer cover is not specifically a dread disease cover on its own. Rather spend that money on getting comprehensive dread disease or severe illness cover first, instead of spending that money on female cancer specifically. Also, if you have accidental death benefit, the need that you have, if you need, after you've calculated everything, you need 6 million life cover. What difference does it make whether you pass away of a heart attack or in a car accident? The need doesn't change because you've passed away in an accident instead of from an illness. So if the need is the same, why put a condition on the risk cover paying out? Why say only if I die in an accident will this pay out? Because then you are not addressing the need. So again, make sure your primary risk areas are out first. I've got a comment here from France the Planet. Hi, Francois. It says, it's like on a plane. When the oxygen mask drops down, put yours on first and then you do your child's. That's a very, very good analogy. Thanks so much for that. I also have a question or a comment from Warren. It says, hi Lourens, Warren here. In the case of a claim, is a premium waiver a good idea, or would you rather cover that in terms of a lump sum investment calculation to cover all monthly expenses? Warren, 100%. I would definitely rather bring it into the planning. As I get to life cover and how do you calculate how much life cover you need, inside that you look at having enough cover to pay for these things in any case, instead of adding a separate premium waiver on top of that. Okay, so accident cover, and then the last one is retrenchment benefit, is also a secondary risk area. It's all good and well, you have a retrenchment benefit, but if something happens to you, you become disabled, you're basically retrenched in any case. And if you don't have a chance to get back to work ever again. Where with retrenchment, at least you can go look for work again. So retrenchment benefit, although in today's life and times, it is quite important to make sure that you are sorted out, whether it is through an insurance cover or having your emergency reserve fund like we teach our students. It is more important that you first get your primary risk areas sorted out. So this is an important thing. You need to review your life cover often. There's one that is a time frame and the other one events based. So the first time you need to review your life cover, I feel once a year you actually have to just have a look at your risk and your life insurance and make sure that everything is still aligned. Because the moment you start moving away from product based, where this product was better than that product and that's why I took it out, to goal based, where we say this is what I need and so I build something that does exactly that, then you need to review it often because the needs will change over time. Firstly, every year the term over which an income needs to be created reduces by a year. So potentially your life cover need reduces every year, or your capital disability need reduces every year because you've paid off a portion of your bond or your cars or any of those kind of things. So at least once a year. Secondly, on certain events that happen, if there's life-changing events that happened, you need to immediately look at your life insurance as well. Things like you've changed jobs, you've started at a new company, you might have a different set of group benefits that influences your life insurance. So if you change jobs, you need to review your life insurance. If you get married, get divorced, have a baby, buy a house, all of those kind of things is a trigger for you to have a look at your life insurance, because you always want to spend as little money as possible on what if money. So when these things happen, talk to your financial advisor, specifically if your financial advisor has worked towards a plan. The way we do it is we do not do business with a client if we don't have a specific plan that we're working towards. There's a goal for each of the benefits that we have on your life insurance. So if that goal changes, you need to adapt to make sure that you still get to the same goal. Got a question or a comment from Stacy. Hi Stacy, shout out to Velma for sharing this radio station with me. Very informative topic. So first, thank you Velma for sharing. Stacy, you're welcome to pay it forward as well and share it with as many people you can. Every Thursday at 10 o'clock in the morning. I'm glad you're finding it informative. It is something that we tend to not talk about. We just have it and we pay it and we just hope that it's sorted out. And very few people actually understand where these things fit in. So it's important that we talk about this. Okay, so let's go on and we talk about life cover, the first of the primary risk areas. So the firstly is why have life cover? So why is it important for you to have life cover? Well, if something happens to you, your ability, if you pass away, your ability to generate an income to give your family independence, the financial security that they need is taken away. They cannot just replace you. Not yet, by the way, but they cannot just replace you. So we need to replace that income, firstly. Secondly, we need to have capital available to make sure that your estate is solvent, that all the debts in your estate can be paid, and that there's money to do the transfer of properties, the executors' fees, setting up of trusts, all of those kind of things that needs to happen. And then obviously there needs to be enough money to invest to generate enough income for the family to continue. Now, one thing I want you guys to keep in mind is stay away from credit life insurance. I see it so often. People take out a car and they just get offered credit life and they just sign it. On their credit cards, they've got credit life insurance. Very often on their bonds, they get a credit life insurance. that is a very expensive type of life cover or insurance cover. And it is a decreasing benefit cover. So what happens is you pay more and more every year, but your benefit decreases every year because it only settles whatever is outstanding on your debt. So it is better to rather take that money and put it into your normal life insurance policy and just make sure that the goals that you have, paying off all your debt, is sorted out through the amount of life cover that you have. So here's the question. If you want to go calculate how much life cover you actually need, how do you calculate it? So the first thing you need to look at is how much debt do I have? So make a list of all the debt that needs to be settled if something happens to you. That's the first thing. Write that number down. Secondly, you then go and you look at how much income would my spouse, my family, my dependents need on a monthly basis to maintain the same standard of living that they are used to. Taking into account a few things, what we are saying here is, firstly, you're not there anymore, which means you don't need to have food, you don't need to pay insurance, you don't need to pay medical aid. The house, the car, the credit cards, the personal loans will all be settled. So all of that cash flow will be coming into your portfolio. You won't need to pay it anymore. And thirdly, your spouse will still be earning their income. So the income that you want to prepare for is over and above the income that the spouse can look or need to or can earn actually. So once you have determined how much income after tax you want your spouse to have, let's say, for example, that is 10,000 Rand. You want to convert that 10,000 Rand into a capital amount. And for that, we use the rule of 300. The rule of 300 says if you want to calculate how much capital you need to generate a specific amount of income, you take the income amount and you multiply it by 300. So if you need 10,000 Rand a month for your spouse to survive, you multiply that by 300 and that gives you an amount of 3 million Rands worth of life cover. Then you take this and you put it all together. You say, well, the debt is 1 million Rand. My life cover that I need for the income is 3 million Rand. So the total life cover that I need is 4 million Rand. Then you go to what you have at the moment. Then you go to your life insurance policy and say, okay, but how much does my life insurance policy pay? How much does my benefit from my work pay, my pension fund, the group life cover on that pension fund? How much does that pay? Put that together. How much is the cash values or any investments that might pay out? Once you've done that calculation, you can then calculate, are you short, are you over? Let's say you are over, you can then reduce the life cover that you need. If you are short, you just top that up to the amount that you need. So that is a very simple way to do it. If you want it properly analyzed, you can contact us and we will send a risk specialist to work with you and do a proper risk assessment. Remember, the rule of 300 is a very broad calculation. The risk specialist will sit with you and calculate it exactly how much you need. Okay, so that's how much life cover you need. One thing you guys must understand about life cover, because I see that a lot of times as well, is, geez, I pay this every month and I'm never going to benefit from it. Life cover is probably one of the best investments you can ever make. It's just not your investment. It's an investment for your family. The only people that will benefit from it is your dependents. You will never benefit from that investment. But if you go and do the calculation, you will never ever pay in more money into that life insurance than what is guaranteed to pay out. And there's no investment that guarantees you a payout for a specific amount. You can't go and say, for 500 Rand a month invested for 20 years, I am guaranteed to get 3 million Rand. With life cover, you have 500 Rand invested and the insurance company guarantees you a specific return on that investment at the time of your death. It's just not your investment. Then the question I get a lot is, what about COVID and the vaccine? So firstly, will life cover pay out if I pass away from COVID? Yes, it will. There's no exclusion on COVID or any of those kind of illnesses. It's the same thing as if you got the normal flu, you passed away, or you got any other illness and you passed away. It's exactly the same thing. There's been a rumor running around, people sending WhatsApps out, fear-mongering, telling people that insurance companies won't pay out your life cover claim if you die from any complications related to the vaccine, because the vaccine is still in a trial phase. That is also absolute hogwash. It is not the truth, so please don't listen to that. There is no exclusions on that on your life insurance policy. All the insurance companies, doesn't matter whether it is you get complications from the vaccine and pass away as a result of that, no insurance company will repudiate your claim for that reason. So you can sleep soundly knowing that that message being sent around is total nonsense. Okay, so that is life cover. Life cover is there. Make sure that you have enough capital, pay off your debts, make sure that your family is looked after and they can generate enough income. The next benefit we need to chat about is capital disability. So capital disability is a lump sum that pays out in the event of you becoming permanently disabled. So this is very important to understand. It has to be a permanent disability before capital disability pays out. If you get into a car accident and you hurt your neck and you lie in traction for 3 months, you will not get a capital disability payout because it's not a permanent situation. You will recover from it. Capital disability pays on permanency. That is very important to understand. And it pays out a lump sum amount. Now, all capital disability is also not created equally. So be very careful when somebody comes and tells you, oh, your disability is costing you X, I can give it for you for cheaper. It depends on what the type of disability cover is. Now, there's a lot of different ones. I'm going to just look at about 4 different types. The first one is total disability. Now, that's the worst capital disability, barring accidental debility. So accidental debility says you have to be disabled as a result of an accident. So if you get a stroke, it doesn't pay out. Total disability says you have to be permanently and totally disabled of doing any kind of job ever again in your life. That is total disability. So you basically have to be very close to a vegetable before it actually pays out. So total disability is on the worst end of the scale. Then we have something called occupational disability. So occupational disability is own or similar occupation. So what that means is if you get a disability and you can't do your job, but you can do something similar to what you've done before, it still won't pay out because you can do something similar. You can still work. And then the next one is own occupational disability. Own occupational disability says if you cannot do your designated job, doesn't matter if you can do something similar, if you can't do your job that you have declared, then it will pay out. And again, permanency is important to establish. And then the last one is functional impairment cover. Now, functional impairment cover doesn't cover your occupation. It doesn't look at whether you can still work or not. It looks at you as a normal human being. It says if anything happens to you that impairs your function as a normal human being, it will pay out. Whether you can work, can't work, doesn't matter to functional impairment. It also, functional impairment pays out in percentages as well, where occupational disability or disability in general pays only either 0 or 100. You're either disabled or you're not. Functional impairment can pay out 25%, 50%, 75%, or 100%. To give you an example, if you lose the use of your left arm, for example, functional impairment will pay out 50%, even though you might still be able to do your job. Okay, so what is the purpose of capital disability? Primarily, the purpose of capital disability is to make sure that you have enough capital to pay off all your debt if something like this happens, and secondly, to do changes to your lifestyle, the bed, the bath, the wheelchair, those kind of things. If you cannot get income disability, you might add more capital disability so that you can invest that for an income. But in our planning, primarily capital disability is used for change to lifestyle and to have capital to pay off the debt. Again, how much do you need? Firstly, go calculate how much debt you have. That is your first amount. Secondly, with change to lifestyle, it is an impossible question. We cannot determine exactly how much you would need because we don't know what's going to happen to you and how much it's going to cost. So as a rule of thumb, we use 2 times your annual income as a goal for change to lifestyle. Is it 100% accurate? No, it's not, because there's no way it can be. But the thought process behind it is your income usually determines your standard of living, which will determine how much it costs to change that standard of living. Somebody earning 300,000 Rand a month, well, his car or her car would probably be more expensive to change than somebody earning 20,000 Rand a month. So that's the thought process behind that. Those two you combine, and that is your capital disability need. If you have to make provision for income through capital disability, you do the same thing as we've done on life cover. So it's very similar as the question on life cover. The only difference here is that you will still be around. You will still have to eat. You would need medical aid. You would potentially need insurance, clothing, all of those kind of things. So adapt your amount that is needed monthly to include those expenses. And then again, let's say you get to 15,000 Rand a month because you are now still around. You multiply that by 300 to get the capital. So 15,000 Rand a month will give you 4.5 million capital. So then you will have 4.5 million capital plus your debt combined plus 2 times annual for change to lifestyle. And that will give you the total capital disability amount that you need. Just another point on the permanency. Usually it takes about 6 months for capital disability to pay out. Again, what about COVID? Well, again, if something happens and you become permanently disabled as a result of the COVID virus, you will be paid out as per normal. Doesn't matter how you become disabled. But chances are very slim, if not zero, that COVID will lead to a permanent disability. So it's not something in this area that you need to worry about. Okay, guys, that is it. That's my show. What we still need to talk about, and that we'll do next week's show, is income disability, severe illness, and then general points to consider when taking out life insurance.
Financially raw, real, authentic wisdom with Lourens Oberholzer from Retire Rich and Happy.
Hi guys, Lourens here. Thanks for watching this video. I hope you found it informative and you got some benefit out of it. Please add in the comments any questions you might have or any other topics that you would like me to talk about. Please subscribe to our channel, hit the bell button so that you can get notified of any new videos that we post so you don't miss anything. Thanks guys, see you around.